All right, let's find out what could be the possible implication for the real estate space as far as we are seeing right now. NHB and housing finance companies, like Shubham is pointing out, they will be included as eligible borrowers for financing low-cost housing projects. Mr. Niranjan Hiranandani is joining us on the phone line right now, Managing Director, Hiranandani Group. Good evening, Mr. Hiranandani. How are you looking at this development right now? How do you see this affecting the real estate space? We have been fighting a liquidity crunch. How is this going to help?
I think it's a very positive view that I'm taking in respect of this announcement. You have to realize this is coming on top of the fact that the Reserve Bank of India reduced the SLR rate for banks. That at the first instance reduced most of the borrowing costs, especially home loan segment, by 50 basis points. The State Bank of India immediately announced within 2 days of a reduction of 50 basis points and improved the liquidity in the market for the housing sector and for the borrowers especially. I think this was mainly for banks as far as the RBI was concerned. I think the Finance Minister is now looking at improving the liquidity of NHB affiliated institutions like HDFC and other housing finance agencies, so their borrowing capacity and liquidity will improve by and also reduce the rates of their borrowing. So effectively, I think over a period of time there will be two things that will happen. A, the liquidity available with banking and financial institutions, including housing finance agencies, will be able to lend more for housing loans, especially for low-cost housing, and also the interest rates over a period of time obviously would come down, but that may not come down immediately till the actual borrowings take place and the availability of ECBs are actually available to the financing agencies. Till then, I don't expect interest rates to fall, but the liquidity availability will certainly expand hugely.
All right, Niranjan, do stay on the line. I am going to come back to you for another comment, but I also have online with us Parvez Umrigar from Wellspun Infratech. Parvez, a lot of moves here to try and, of course, make it a lot easier for some of those infrastructure companies to refinance their rupee debt through the ECB route. What are you making of today's developments?
Well, I haven't read the exact fine print, but from what I understand, there is a relationship to the ability of having earned an export earning, and a certain percentage of that is permitted in terms of the ECB. Now, if that understanding is right, then one must understand that the sectors of infrastructure, especially roads and energy, really are localized homegrown sectors, and their ability to generate export earnings is practically nil.
Right. Parvez, they've also made it easier to go via the automatic route as opposed to the approval route. Is this going to help? And, we were just speaking to Niranjan, he's also online with us, about how, long it might take to actually see the effect of this on ground.
Yeah. Well, I think I was touching upon the basic aspect that if there is a relationship drawn to the earning ability, then it will have a limited use for the infrastructure sector.
So, just to bring you in on this point as well, is it going to be easier to be able to refinance debt going ahead from here? As far as you're concerned, Mr. Hiranandani, how crucial was this issue, and how much do you see this helping the entire space? Of course, we're looking at infrastructure also reaping rewards, but when these rewards will actually kick in is still a question, isn't it?
Yes, it is. But you have to understand that both the Reserve Bank of India and the Finance Ministry seem to have one objective, that is to expand liquidity available with the banks and financial institutions. So if I'm correct in terms of understanding what they're saying, is earlier with the banking sector having more liquidity, which was about 60,000 crores of rupees of additional funds immediately made available by reducing by 1%, then NHB wanted to do through four housing finance companies also the same effect, which was not available, through which the RBI statement on SLR was meant to be. So I think what they have actually effectively done is to help now the NHB companies to use another route of external commercial borrowings for the purposes of reducing their costs of funds and effectively making available more money, especially for low-cost housing.
Right. All right, gentlemen, thanks so much for joining us. Niranjan, just while we are with you, just on a slightly different topic, but just, wanted to get your comment. There's also been some news about the finance minister pushing perhaps for some of the realty developers to actually bring down prices in order to increase, demand in the market. Just wanted to get your perspective on that.
I think I've mentioned that earlier also. The companies which have over-leveraged and where the banks have some say in terms of how they are going to operate, obviously their banks are going to pressurize the developers to sell it immediately and to liquidate the funds and pay off the debts. But there are many companies which are not over-leveraged. I don't think it will make any difference to those companies because the leverage available to the banks or financial institutions is actually not there. So I think what is in effect happening is that the finance minister is saying that you can't use banking funds and hold on to properties and expect a rise in prices when you are actually required to pay back these loans to the banks and financial institutions and unfairly hold up the market. So I think it's true for companies over leveraged, but it won't be applicable for all companies or all real estate companies across the board.
All right, Mr. Hiranandani, Mr. Umrigar, many thanks for joining us this evening with your perspectives. Obviously, a boost coming in on the external commercial borrowings front for India Inc. Moving on, the Finance Ministry is also pushing for key reforms. They have been doing that for some time. Today, they've approved 49% foreign direct investment, FDI, in the insurance and pension